Are we in a recession? Are we not in a recession? How are you thinking about the macro right now? And if we are going to get a recession, what kind of recession is it going to be?
Thanks, Guy. Nice to see you. So recession, that is the big question. And, when you look at the first quarter and second quarter, and you looked at negative growth, it was really about inventory buildup. And the NABR probably won't classify that as recession because the 528,000 jobs that were created. But the real focus that we have right now in the markets, the technicals, is the yield curve. We've not seen the yield curve, 2s, 10s inverted, currently 44 basis points, this inverted since 1980. So you can go back to the 20 recession, the 2008 recession, the 2001-2 recession, where the yield curve got to 42 basis points inverted during the dot-com bubble burst. But you haven't seen this level since you last had inflation roaring, and that was 1980. Mm-hmm. So go back to those charts and focus on that. So we're of the opinion that Powell is right. And Powell said at the last presser, coming out of the Fed meeting 2 weeks ago, he said, you haven't felt it yet. And what he's referring to is financial conditions. So imagine from March of this year to September, which is a couple months from now, that the Fed, and imagine this from the beginning of the year, that the Fed actually moved 300 to 325 basis points. Just imagine that, because that's what's currently happening. And so we think Powell is right. Big picture, inflation will roll over. So it's currently 9.1% CPI. We'll get that news on Wednesday. PPI around 11% and change. We'll get that on Thursday. And we believe those numbers roll over. So as you start next year, we'll be dealing with 4 handles. Mm-hmm. But we think it'll be stubbornly high at like 4 and change.
Right.
And so the Fed that's going to move rates to 3.5% isn't going to allow rates then to ease. And the markets are expecting the Fed to ease sometime into next year as you start to move into a little bit more softening.
Right.
And we don't think that happens. We think because of inflation, they have to stay there. And so what's causing this summer rally? We call it FOMO, fear of miserably underperforming. Positioning's light, and the path of least resistance has been higher. And so that's what's happened over this last couple months as the market was oversold.
Hey, Bruce, great to see you. It's Alex here in New York.
Hey, Alex.
So that you just accurately and articulately explained how we're responding to data points. So any good news is then bad news. Has been kind of shifted a little bit to good news means there's a dovish pivot later on. It gets very confusing versus what the Fed's saying, what the data's saying, and then what the market is saying. How do you know which assets to buy with all those 3 things trying to play out?
Well, I think you always want to start with your evaluation. First of all, it is very confusing. I'm with you. And so you have this recession risk that we think over the last week or two has been reduced, but the yield curve is further inverted. You have earnings up, but CEO confidence is down. You have revenues higher, but margins are compressing. And you have employment stronger, but claims are actually, unemployment claims are rising. And so it's all kind of juxtaposed with this geopolitical backdrop, and it's all very, very complex right now. In fact, for anyone analyzing markets or the macro, it's probably never been more confusing than it is today. And so I'd start with the equity markets, and I'd start by saying, look, Q2 revenues are up 14% so far reported, and earnings are up only 7%. And what that means in one word or 2 words is margin compression. The quality of earnings is going to be the issue for the markets in the coming year. And our base case is for a very mild recession, Guy, a very, very mild recession. And, when you have a recession, earnings typically declines by about 20%. That's what you've seen in each of the last 4 recessions. But this time, you're not going to see earnings decline by 20% because earnings, and this is very important, and revenues are not inflation adjusted. And so because they're not inflation adjusted, you have earnings up, 7% so far. Most of that's commodities based, but 7%. And you have revenues up 14%, but it's not inflation adjusted. So it's a really important consideration. We think next year earnings will fall 7%. And so $215 earnings will become $200 earnings, and the market's thinking $230 earnings. And so with that, we think the equity markets are probably overvalued. And credit markets are probably
okay, Bruce,
undervalued.
Okay, let's go on to credit. Bruce, the defaults haven't happened yet. And in your kind of scenario, your recession scenario, what do defaults look like? When do defaults kick in? Because at the moment, the credit market looks solid.
The credit markets do look solid, but we haven't felt the higher rates. And as lenders, borrowers start to roll over their debt at 300 basis points higher rates or 200 basis points higher rate, that will be felt. Just like you feel in the housing market where mortgage rates go up, the housing prices start to flatten out. So it's the same thing companies will start to feel. So what happens with this first is sometime towards the end of the year, as margins further compress earnings, as borrowing costs increase, as cost of goods increase, which causes the margins to get squeezed, we think downgrade cycles begin. And in fact, you've just started to see more downgrades than upgrades in the high yield market for the first time in a few years happen this quarter. And we think that will be a continued trend as we get into the rest of the year. And with that, after downgrades will come defaults. So I'm looking at more a 2023 forecast in terms of the big downgrade default cycle. Not so much this year, but because it takes a while, like Powell said, for financial conditions to tighten and for it to be impacting both companies' confidence and ability to, for certain companies, service their debt.
So Bruce, what are you investing in then right now? And I mean, part of me says, how much are you waiting then to buy that default cycle? But that's a long time to wait. So where are you right now?
So where we're investing, we like structured credit a lot. So RMBS and CMBS, real property that's inflation protected, and we own the debt, or we're making private loans that are secured by real property. We're doing the same thing in any type of asset-based, from aircraft to engines, property and equipment. And so we're very, very active there. Yes, we've dialed down our investments in distressed because we're not in a distress cycle yet, but we're setting up for what we think is going to be a really nice distress cycle next year, but we'll have to wait for that. And in terms of the overall fixed income markets, look, with higher rates, and the Fed will continue to raise rates into the end of the year, with higher rates, the coupons that we'll earn are much more attractive than they were when you were in a ZIRP world. And so we are very grateful to, having a marketplace where our investors can have a better rate of return, because markets are not manipulated at zero or a zero interest rate policy, which is really financial repression. So because of inflation, and because of all the printing of money that caused the inflation, I think the Fed will be much more judicious in this next round in letting rates stay a little bit higher because inflation is higher, and because Powell is bent on bringing inflation down. It's really critical that he brings inflation down, because his name and his reputation, his legacy will be defined on whether he can break inflation, because of all that happened before, which is the printing of money supply and his comments about it being transitory and acting so late. And so now he has to overcompensate the other way and keep rates firm to actually break inflation.
Is the US the place to be right now? What do you make of what is happening in Europe? You talk about distressed opportunities emerging in 2023. How much earlier do they emerge in Europe, do you think?
Well, first of all, the U.S. is the place to be. I'm super bullish on the U.S. looking past this next recession, because we're going to be onshoring, bringing a lot of our supply chain back. I think it's a great country with the best companies in the world right here, and we're really well positioned. So I can't tell you how bullish I am on the U.S. long term. I think Europe is in a very difficult mix. The most complicated sector that there is some of the emerging markets, particularly those that have been hurt. Countries like Pakistan and Sri Lanka, but all the noise that you're seeing in emerging markets, there's a real bifurcation that's going to start happening there, and that's central to that is the theme of China, because China's become very, very complicated. Number one with Taiwan, but number two, their banking system is a complete mess right now, with all the construction loans and real estate loans that they're burdened with, and how leveraged those balance sheets are. We haven't begun to hear the story of how China's going to play out, given the geopolitical risk, and it's so much more important. As important as Russia is with Ukraine, it's been devastating what's happened in Ukraine. But for GDP, global GDP, China's a $20 trillion economy. Russia's barely a $1.4, $1.5 trillion economy. So much more impactful. But I think Europe is going to be in for a very long slog of really slow economic growth. And what's happening, in terms of transitioning from dependence on Russia to becoming independent, is going to be some pain along the way before they begin to recover.